Welcome back, everybody. As Adam mentioned, I'm Victoria Webster, the Director of Fixed Income here at AFME, and I will be chairing the remainder of the sessions this morning. So, although it's a real shame that we can't all meet in person for the conference like we usually do in Brussels at this time of year, I'm still delighted that we're able to come together to hear from our key industry experts about what we can possibly expect beyond 2020. So with that in mind, it's now my pleasure to introduce our second panel, which is looking at the future of the government bond market. And it's being moderated today by Michael Carteen, Senior Government Bond Analyst from Refinitiv. I would now like to welcome Michael and the panelists onto the screen. Michael, over to you. Thank you.
Good morning. Good morning. Thank you, Vicky. International Financing Review, part of Refinitiv. But welcome to our panel on the future of the government bond market. Really excited about this topic and how appropriate it is, as we'll see, as I will explain. But with us today, we have Wilfried Bolt, Senior Investment Manager, Fixed Income PGGM, Kaelin Anev-Jans, CFO of ESM, Niels Kostens, Head of Government Bond Trading at ABN AMRO, and Tom Britton, Managing Director of TradeWeb, or with TradeWeb, excuse me. We've had a lot of discussion about being able to work from home, etc. So I won't dwell on it too much, but I mean, just thinking about the technology and the future is now is really appropriate for this conversation. I was supposed to be doing this. I've got a new web camera and everything set up on my PC, and it hasn't worked for firewall or something. And now I'm on my phone, literally in the last 5 minutes or something. So it's amazing. And continuing with this theme, I'd like to start with an audience poll, please, of how many people here today are working remotely rather than at the office. So if we could see that, please. Okay. We've got a lot of ground to cover. Some of it's already been covered in Natalie's panel and earlier panels. Hopefully we can bring you different angles because we'll be going over some of the same subjects. But hopefully we won't repeat too much. One thing that is I think worth considering, I'm not going to dwell on, but a number of people have raised the issue to me that maybe we should be concerned about regulatory issues with working from home. So as we continue with the rest of our discussion, I think that's something we should bear in mind. Similarly, from a regulatory point of view, the Netherlands is in the process of moving towards some big pension fund reforms. I don't want to dwell on it too much, but for a minute or two, Wilfried, if you can tell us what we have to look forward to here. And then we'll get into our main topics of SURE and next generation EU programs, etc. So Wilfried, please.
Yeah, good morning, Michael, and thanks, AFME, for inviting me to this panel. Yeah, I'll try to keep it as short as possible. Indeed, we are a bit behind schedule, indeed. So, although we could have a whole panel on the transformation of the Dutch pension system, I imagine it's maybe much more of a topic for next year. But just to set the scene, so what is happening is that the Dutch pension fund sector is almost 1.5 trillion euros in assets, which is twice the GDP we have here in the Netherlands. And of these 200 pension funds in the Netherlands, 2 pension funds are almost half of total assets. It's the ABP and it's our own client, the healthcare sector pension funds. 30 to 40% of our assets is held in government bonds. And so if this panel is about the future of the government bond market, I think it's quite important what will happen to this, say, 500 billion euro position in government bonds over the upcoming years. As you alluded, it's a regulatory change which is coming our way, but what is quite important to mention to the public is I suppose that it will be something which is going to be live only in 2026. And so we will have the transition period over the coming few years. And what one does not have to expect is that there will be big changes in the next year or maybe in the next 2 years. So it's a topic for maybe next year on this conference. And although we are moving from defined benefit towards defined contribution, there will still be a role for government bonds in the portfolio of an institutional investor. And so there will still be a focus on liquidity. There will still be a role of a diversifier versus the other part of the sheet of our pension fund clients. And 60 to 70% is invested in risky assets, and especially in a downturn, as we saw earlier this year, government bonds proved their value. So they will certainly remain on the balance sheet going forward. So there will be a shift of this 500 billion euro in assets in the Dutch government and the Dutch pension fund sector. And I think the biggest shift that we will see is that we will move from longer on the curve towards a bit shorter on the curve. What we will also see is that we will less focus on daily hedging characteristics. So currently every day a hedge ratio is calculated and a coverage ratio for pension fund is calculated. That is going to disappear. So what we are going to do within the government bond market is focus a bit more on return and a bit shorter on the curve. But as I said, maybe much more of a topic for next year.
Okay, thank you. Can I just ask or clarify? You said 2026 you mentioned. That is the end of the transition period, is that right?
Yeah, so next year the law will be penciled, and then there will be discussion between the two type of contracts pension funds can choose. Then there will be a period of transition, and only from 2026 onwards the new system will be live. And it's still a big question whether the old pension rights will be built into the new system, or that we will have two systems next to each other.
Okay. Nils, ABN Research last month estimated selling of around 250 billion euros of fixed income. Just over 200 billion of that is government bonds, mostly hitting longer dated AAA and AA. But as Wilfried said, this is maybe more a story not for the coming year, but after that, 2023 to 2025, I think you mentioned. Is that
Michael,
something that we
I
should...
think the normal reaction would be naturally that you would see an expected cheapening of asset swap levels, but we also have quite a substantial buyer still at the moment in the ECB of the fiscal and monetary stimulus. So I don't see that going away too easily in the next coming years. I think there will be quite a big support for the market, and as already Milton Friedman once said, nothing is so permanent as a temporary government bond program. So I think that will also continue for a while. So I think that's still the AAA sector, which has been supported, also due to regulation for the last 10 years, well supported. So I think that demand will still be there.
Okay. Let's go on with the Sure and the Next Gen programs. Last year's conference, I hosted a panel on structural effects in trading and liquidity. And as I was going over my notes from that conference, I came across a common acceptance among my panelists that a common Eurobond is both possible and necessary, but there was quite a bit more skepticism from the audience. As discussed in Natalie's opening panel, we actually have that common Eurobond. So can you gentlemen please give us a discussion? I guess, Kaelan, I think you're a good place to start with.
Thanks, Michael. And I think you're alluding to probably the biggest game changer of 2020 after the tragic COVID-19 that hit us all. I think what really markets did not expect is how fast Europe actually acted in this space. First, with the monetary response of the ECB, which Niels alluded to, the by now 1.3 trillion PEP program. But I think what even more surprised markets is the European fiscal response. It started in April with the 540 billion package of my own institution, the DSM, EIB, and SURE, and that was then topped with 750 billion in July with the Next Generation EU. So today we have around 800 billion of safe assets, European safe assets outstanding with ESM, EIB, and the Commission, and this will double, if not triple, depending on how much of the ESM and others are used. And that is a real game changer. And what I see as something really positive is at the first wave of Corona crisis, markets reacted with a lot of volatility. VIX index was up, spreads of governments went up. If you look at it today in the second wave, actually markets have remained very calm. So they have a real trust that this monetary and fiscal response is working. And it's good because, well, Niels can trade that at ABN AMRO, and Wilfred can buy all of this because many of these issuances will be either social bonds or green bonds. So I think Europe is really leading the pack here.
Another point to make is that we now have a European Union-wide safe asset, which we should make the euro a stronger reserve currency or boost its position as a stronger reserve currency. Does anyone want to care or would like to discuss about what we've mentioned so far, what's been mentioned so far, or the reserve currency aspect?
I can maybe start, and my fellow panelists can join. One thing that I've been seeing over the last few years is that there's an increased interest in the euro as a reserve currency. So I see it in my own books where I've seen central banks actually go up, and not only in the US dollar issuances that we do, but also in euro issuances. And this year we will have a record amount of central banks that buy our bonds, which will be close to 40% of our all euro-denominated issuances. And just before Sure went live in October with their first issuance, one day before we did our own issuance, and we had 72% of central banks participating, which is exceptionally high. Generally, this is around 20 or 30%. So you see that central banks globally and reserve managers don't believe in the thesis of euro breakup anymore, but see the euro more and more as a strong alternative to the dollar for reserve management.
Maybe I can add a bit to what Colin is saying, and not so much on the reserve currency side, but maybe on the fact that Colin alluded to the fact that EU is going to issue both green and social bonds, which is indeed quite an important aspect and in an area I think Europe is indeed leading. So what we have done on PGM's side is that we used to invest only in government bonds in our rates portfolios until recently. And then since 2017, we decided to move into the SSA space as well, on the risk-free side of the balance sheet of our clients. Why did we do it? We did it because they have an ambition not only on the financial side to pay out pensions and preferably pensions, but also they have societal goals next to these financial goals. And with green and then also social bonds, there's a clear instrument in the fixed income side where you can fulfill both of these goals, both on the financial side and also on the social side. And what we have seen, of course, on the SSA side is that they have started to develop the green bond market in 2007 with the World Bank and the EIB, and all the innovations in both the green and the social markets has come from the SSA side. So as Colin said, ESM is ready to issue social bonds. EU has issued social bonds, will issue green bonds. And the whole taxonomy and the debate about green and social bonds has been derived through the issuance of SSAs. So it has given us a leeway to move into that space. So I do think that is a valuable addition from the EU as an issuer indeed.
There's been a worry about Sure and the next gen programs cannibalizing demand from the existing markets, like the ESM or other governments, especially OATS from a lot of the research I've read. Nils, I'm sure we'd like to have you address it, but Tom, maybe you've got a quick comment that you can start things with first, please.
Yeah, certainly. Obviously, just to clarify, obviously from my perspective, is sitting in from a trading platform, secondary, what we can see is the secondary market activity. I'm not here to sort of provide an investor or market making angle, but certainly some useful context I think we can find from platforms such as TradeWeb and other similar platforms. I think the first thing, actually, going back to Callan's point about the central bank buying of the ESM bonds, we see very similar across the EU issued securities that the central banks do make up around 40% of the activity. In terms of what we've seen so far on the new issuance, I mean, I think as expected, highly successful first issuance. Initial activity was a little bit lighter than expected, but ultimately securities is still behaving like SSAs. I think we'll come on to whether they move on to government bonds imminently around the liquidity. The activity is in line with market expectations. The investor base is very much in line with market expectations. Central banks, real money similar to PGGM, etc. And TradeWeb specifically, a number of UK accounts on the real money side who've been particularly active. And I think the important thing from our perspective is that the liquidity in these bonds, obviously, how you define liquidity is very difficult. One person's liquidity is different to someone else's, but from from a trader perspective, the liquidity we see in these bonds is very important. We've seen across all 4 of the issuances, the following day after pricing, we've seen at least 25 market makers showing bid offer up to sizes of 50 million each way. We see 15 plus market makers sending axes into the platform, directional axes into the platform. And again, the bid offers have been very much in line with their peer securities. 5 years around 6 to 7 cents, for example. So, liquidity perspective, quote rates are very good. Client hit rates have been very good. It's much the same, much in line with other SSA issuance, and again dominated by real money and central banks so much. So far, much of the same. We haven't really seen a huge number of new entrants per se into the market because of these new bonds, and we certainly haven't seen any of the other markets, the OATs and so on and so forth, being hampered because of it. Again, but time will tell. I think liquidity in terms of the curve, and Niels, I'm sure we'll talk about this, but in terms of the additional securities being added and the curve being structured more, will define that a bit further.
Niels, please.
Yeah, Michael. We should not forget where we come from. The yield curve was, as it was currently standing before the issuance in October, we're having maturity lines of each of 5 billion. We're looking now at the issuance of at least, or roughly already on the benchmark deals, roughly the 5 and 10 years of issuance of 10 billion per line. And I think for next year, it's already estimated, the issuance will be above 300 billion on the recovery fund, also combined with the sure bonds. And that will make naturally a big difference. The size of the trading, and also if you look at that has the size of the Dutch government bond market. Well, that's a rather liquid market. So I have faith in that this market definitely can be liquid. The challenge naturally will be the big chunk that the ECB is buying. Will be expected up to 50%, which is possible. And actually also like the pension funds themselves and other insurers holding it in their ESG portfolio. But I must say what surprised me a bit, and I was worried a bit after the first issuance when I saw the investor type allocation coming out, that hedge funds and also banks were allocated like almost approximately 1%. I was a bit worried about that because that might give less free float in the street, and also then jeopardizing a bit the liquidity. But on the second one, on the 5 and the 30 year, we saw already in the 5-year sector an allocation, a healthier allocation to the hedge funds of 8%, which I was quite happy about, because what we've seen also in this COVID-19 world, or in geopolitical risk return, like we have seen in spring, hedge funds, fast money, they provide liquidity. So we might have pension funds on the other side, and the fast money, or what is fast these days, at least investor types considered as hedge funds being on the other side, which we've seen quite a lot trading. And also Tom, I think, can also verify that over the last years we've seen also fast money percentage of tickets electronically going through. What used to be more like voice driven will be now almost up to 1/3 of the tickets on the electronic trading. I think Tom might confirm it, but I think that's the last figure I heard.
Yeah.
So that's I have faith in the liquidity of the future in that point.
Yeah. On that point, Niels. Sorry, Michael. Just to comment on that point from Niels, just to say, hedge fund activity, the fast money hedge fund activity in the last few years, if you look at 2-3 years ago, it was probably around 10%, 15% at best. Now, as Niels said, it's around the 30% mark, if not higher in some security types. But we haven't seen it yet on the sure bonds, but I'm sure that will come in eventually. I know they're certainly looking at the issuances.
Niels and Kaelan, should we have any worries about the liquidity in the sure or the next gen programs?
I'm not overly worried from my side, and I compare them very much to the ESM because they're pretty much the same credit, pretty much the same shareholder. And even though the ECB buys a lot, and if I look at my own securities, the ECB holds around almost 50% with PSPP and a little bit more if you add PEP. but we monitor quite narrowly and also with new technology how we are trading in the secondaries, and also by using TradeWeb and analyzing on a monthly basis how much they trade us. I still see a turnover of 20 to 30 billion each quarter. So there is sufficient liquidity out there if you want to trade. Secondly, also the ECB, of course, is providing liquidity. So if you hold a sovereign asset, or if you hold SURE, or if you hold the next gen EU next year, you know there's always a buyer in town. And that has attracted also a lot of, well, you mentioned hedge funds, but also central banks around the globe. But maybe I can add just one thing, which, and I fully agree with what Wilfred and you said about the importance of SURE. I also think that politically, the message that we have given in Europe 10 years ago, it was always a bit patchy. It took time to take a decision on fiscal responses, on monetary responses. Now we acted so fast, so that basically the thesis of Europe or the euro falling apart is not there anymore. And you saw that this summer with, for example, Japanese investors moving into Italy quite heavily. So you see that globally there is more appetite for Europe. Europe is becoming hot.
Maybe to add one final point, there's a bit of background noise. One final point, maybe to what Carl was also saying. There is a lot of speed indeed with EU insights this year, but it's also a bit of I get a bit nervous actually when ECB starts to buy 50% of certain bonds, and especially if you look at everything which is going to be issued by the EU is not going to be issued by national governments. And that's my mathematics. And ECB can only buy 33% of a government bond, while it can buy 50% of a supranational bond. So it does mean that if the EU starts to become a bigger issuer, ECB involvement will probably be bigger and will crowd out private markets more than in the past. And so what we have noticed, for example, this year is for EIB bonds. They have become so expensive, anecdotally due to the ECB buying, and we had to sell all our exposure to EIB, and the same thing might happen to the EU. And if we sell all our exposure as an investor, it becomes much more difficult to engage with the issuer on these green or social thematic developments. And so what we have done in the past, both the Netherlands and Germany, but also with EIB, when they were developing the green and social frameworks, we got into an interaction with them. What is green, what is not green, what is social, what is not social, how should we report impact according to investor preferences. But if we are not involved anymore as a private market participant in these bonds, this interaction will also disappear, in my opinion. So I think there is a bit of a danger when the ECB starts to buy 50% and therefore crowds out private market participants.
Another question, it was sort of addressed earlier, I think, in Natalie's panel, but I'd still like to ask, SURE and next-gen bonds, I think we can assume at some point, I think everyone does, that they will move to government desks. But I'd like to ask now, another audience poll, how many people are trading SURE bonds from their government desk or the SSA desk? And Wilfred, I think you had an answer on as to how you're treating these bonds.
Yeah, no, that's correct. I think I explained it shortly already before, is that we used to invest only in the rates portfolios. Also in government bonds and rates portfolios, and next to that we had a credit team investing in pure credit. And there was something in between, which was either covered bonds or SSA type of bonds, which were not covered within PGGM. We decided to include SSAs in 2017 in our government bond portfolios, first only with the thematic bonds, the green and social bonds, and expanding that now into the conventional bonds as well. And for the EU as a issuer, we have made even a special place because it is, well, as close to a government bond as you can come, I would say. And so I do agree with Colin. It resembles very much ESM or EIB, but in our opinion, it's even more close to a government bond than these other issuers, and therefore we got bigger limits on the EU than traditional SSAs.
Okay. An interesting issue came up during our prep call last week, and obviously we've been expressed concern. You guys have expressed some concern about the ECB buying of the SURE and next-gen bonds, and the EIB. Callan, I think, especially the EIB's green bond bonds. You suggested that, or one of you had suggested that the ECB's buying had made valuations of the EIB's bonds, green bonds, unattractive, and maybe even makes the program unattractive. Will you have address that question or issue quickly, please? I've lost sound. Okay.
I think Wilfried already touched on a bit on that topic correctly, Wilfried.
Sorry, I thought the question was directed to Colin.
No, I know,
so
but he seems to be offline. Or
Colin,
John,
it
I
seems you
think your microphone might be on mute. We seem to have lost your sound. Yes.
You hear me now?
Yes.
All right. So my browser had to be refreshed. That's I think also part of the way of working from home. No, it wasn't me that spoke about the EIB green bonds, but I do
Okay, sorry.
see a increase in ESG interest. So basically, it is sometimes indeed difficult to get ESG bonds because there's more demand than supply at the moment. There's some good news. So for the first time, ESG crossed the 1 trillion in outstanding this year. It's a record year for green bonds. Social bonds are 5 times bigger than last year. So it was 17 billion of issuance just in 2019. The COVID-19 crisis showed that social bonds can be actually a good answer. So we now have almost 120 billion, so 5 to 6 times more. But I see more and more demand for these type of assets. So I think on the long term, this is a real growth market. And what is interesting here is that Europe is really in the lead. So if you look at the currency, in green bonds, 45% are issued in euros. It's only 26% or so in dollars, and the rest in other currencies. In social bonds, more than 2/3 are in euros. So Europe has really become a hub in issuance, in currency, but also in investments like the PGGMs, APGs, and all those players. They are huge investors in this space. So I think Europe here has a first mover advantage. I hope we can keep that. And I'm very hopeful that the EU taxonomy one day can become some sort of a global standard, a bit like GDPR. There's a beautiful book of Anu Bradford, a professor in Columbia, that's called Brussels Effect, that how European regulation can become global regulation. So I hope that here Europe can keep that lead, and that we can become a standard setter, a gold standard for ESG finance around the globe.
Yeah,
Wilfried, did you have anything to add? Sorry.
Sorry, it's Tom, Michael. So I was just going to say, I think the pandemic has obviously caused a major shift in investors' approaches to social issues. And again, from a platform perspective, in terms of the number of securities being added, we've added over 60% more securities between March this year and September this year versus the same period last year. So we've seen a big growth in that perspective. Volumes and activity has increased over 80% as well, predominantly in European bonds, so supranationals, IG credit, ETFs as well. Govies less so, but obviously we've had the 2 recent German issuances very prominent recent additions. And so the number of securities keeps growing, and they're fitting into the European government e-trading fabric in the same way as before. They kind of using the 10-year examples in both instances. They're about a tenth of the activity. They're slightly more expensive, but liquidity, again, as I've mentioned before, is very much on par with what we see with their twin bonds, and these are going to continue to pick up. As they get tapped, the activity will grow, and I'm sure there'll be increased activity from the other European governments' issuance over the course of the next 18 months or so.
Thank you. Sorry.
Yeah, no, maybe indeed, because as you asked me indeed to comment maybe on Canon, I do think indeed that both the issue, but also the issuance, but also the demand side of green and social bonds is indeed exploding, and it's a race between the two. And so of course, it is a record year in the sense of green and social bond issuance, but what you also see is that it's a record year in terms of demand. And what we noticed, for example, from our biggest client, healthcare sector pension fund, is that they just published last Friday their new 5-year plan. So it's called Investment Plan 2025, and the main focus again is on sustainability. So on the equity side, we have reduced the carbon footprint of our equity portfolios by 50% over the last 5 years. For the next 5 years, it's going to be another 30%. So the long-hanging fruit has been picked. The next 30% is far more difficult than the first 50%. That's on the equity side. Across all assets, what we have to do is we are looking to find 20% of the balance sheet of PFCW in 2025 in SDG-related investments. And it's not all SDGs, because then I think you could imagine for many investments and SDGs. So we have some focus SDGs, which we think are important together with our clients. So what the healthcare sector pension fund does is they ask everybody in the pension fund via polls what they do think is important. In this case, it's both healthcare and it is climate. And so there are particular SDGs related to that. And 20% of the asset mix will be allocated towards these SDGs in 2025. So you are talking about approximately 50 billion euros in our asset mix in 5 years' time, which will be invested in these investments, which will both target financial returns, but also target societal goals. And so what you see in this race between demand and supply on this thematic type of issuances is that sometimes things tend to be quite expensive, and sometimes it's correct. Say during the crisis in March, April, what you tended to see was that the green bonds outperformed conventional bonds because of the steady investor base for these kind of bonds, but later it corrected. So as a active investor, we also try to add some value by exploiting these inefficiencies over time between conventional bonds and green bonds, and especially in volatile times, there is this difference between supply and demand in these types of, which is a nice opportunity to exploit as an investor.
Thank you. We more or less have shifted into the subject of green bonds and social bonds. Green bonds, I think everybody's pretty comfortable with, and they've been around for a little bit longer, so I don't think we need to get too into them. But just quickly on social bonds, there is a little bit of skepticism about whether we actually need a new sector for social bonds and maybe how viable it will be over the longer term. I know you guys have already touched on it a bit, but maybe can we expand on that a little bit more if there is skepticism or it's just not warranted?
Maybe I can start and others can add. As Wilfred mentioned, we as ESM created also a social bond framework based on the ICMA principles. And I personally do see a real distinction between green and social bonds, because green bonds are really there for transition. So if you build solar plants or you build wind farms, etc. But if you want to help, like the ESM, healthcare expenses in Eurozone countries, which are hit by a first wave of Corona crisis, second wave of Corona crisis, you can't explain that as a real green bond, but it is in social purpose. And ESG bonds, which I like to look at more, the social element was a bit forgotten. There was one corporate, Danone, that issued one a few years ago. Then some supranationals issued it. But in 2020, the Corona crisis really showed the social bonds have a space. So if you look at our own social bond principles, we follow the use of proceeds. So if a country would take our pandemic crisis support, they will need to declare whether they used it to build hospitals, or they use it for vaccines, or whether they use it for respiratory devices. So there is the use of proceeds need to be described very well. But as an investor, you know that by buying this bond, you're really solving a social issue and helping a social purpose. And for me, the numbers say it, right? If you move from 17 billion in 2019 and you're at 120 billion today, and both sure issuances were 100% social bonds to help people in jobs across Europe, I think it shows a success, and that there is a real demand, and that there is also a price advantage of issuing social bonds.
Yeah, maybe one skepticism from my side, Michael, is indeed whereas in a couple of years ago there was this market thing about greenwashing. I think people now start to be sometimes a bit afraid, including myself, of social washing. So there are many proceeds which can be claimed in a social bond to be of social value. And what we noticed in the crisis, of course, was that people tended to both finance the healthcare side of things, but also the SME side of things and unemployment benefits. And they tended to mix the two. And as I explained earlier, what we tend to focus on with our impact investments is on the healthcare side and on the climate side. So what we do not want to finance is SMEs via a social bond. So it puts a bit more effort on the investor to indeed dig out what the proceeds are actually used for in social bonds, whereas for green bonds, yeah, it's much more straightforward. And one last remark from my side on this topic is I do think it would be useful that if the governments start issuing social bonds as well. And similarly to green bonds, we do not think that a government, when they issue a social agreement, is going to change their expenditures because it's a democratic process. It's not going to change. But what it does do is it creates transparency in the market. It sets KPIs, it creates impact reporting, it sets an example, and it accelerates the private sector. So therefore, it would make for a nice example if governments start to issue social bonds as well.
It's interesting. Thank you. Nils or Tom, quick comment?
I think, Michael, for the long run, I see a bit more of a structural kind of issue inside on the green bond compared to the social bond. But the market will be bigger, I think, in green also now with the new recovery fund. So I expect a bit more liquidity on that part. And also, I think the name sure already says it. It's like temporarily support to mitigate the unemployment risk in an emergency. So it says it starts already with temporarily. So I find the green one a bit more structural and a bit more interesting for the future.
Okay, thank you. Tom, quick comment?
Yeah, I think, as I said earlier, I think we've seen a big boom in the issuance of the green and social bonds recently. I think that'll just continue to follow suit. Other borrowers will continue to follow suit in both areas.
All right, thank you. Let's turn over to technological developments and AI evolution and related subjects. We discussed technology on last year's panel, my panel at last year's conference. And just remember, guys, I remember these things. I take notes, so wait until next year. But we discussed this technology last year, and one of the quotes that I have, or one of the notes that I have from that panel is, technology within large banks is horrendous. There's very little integration. Each sector uses different tech for their systems, for different markets, for corporate bonds, governments, derivatives, etc. After speaking to a friend last night, I get the impression that this, alongside tech developments and especially AI in general, they're more, it's an evolutionary process. There's not revolution, it's a work in progress type thing. Would that be a fair way to sum it up? And are there specific issues you guys are looking at or interested in or points to make?
I think, if I may, Michael, I think horrendous is a bit maybe too strong.
Exactly.
But then again,
Yeah,
it's like
wrong,
yeah, I agree. It's more like a continuous. We've seen we have one automation natuurlijk on one side, and you have artificial intelligence on the other end. But the interesting part is also what happens if the market is in dire straits, like we've seen in March and April. Where does artificial intelligence brings you? Well, the flow is drying up. The street is not quoting interbanking anymore. Banks are asking wide bid over spreads. Clients almost need to cross trades on the other hand, other counterparties. Otherwise, it's not doable to shift size. And then you see that it's more like you have human intelligence combined with artificial intelligence, and I think that's your future going forward. It's not one or the other. You always like in spring, you need human judgment about trading. But maybe could be I'm a bit biased because I don't want to be replaced by a cold machine.
I think we all are. Tom, we'll ask for some numbers from you in a minute because I have some numbers from last year also. But
Yeah.
Kaelan, you had a interesting comment when I spoke to you earlier personally about AI and algos and how you're using them at the ESM. Could you expand on that, please?
Yes, from our side, we looked at we see what works and doesn't work. So there are a lot of fintech companies out there, and some have solutions that sound great on paper, but in reality they don't seem to work. For example, on market sentiments,
Okay.
how do you measure a market sentiment on a country? But where we use it is in market intelligence and our own bond trading. So we are collecting data from the 40 banks like ABN AMRO, but also from the trading platforms like TradeWeb. And what we have seen as a shift is that, for example, electronic trading went last year for the first time above 50%. So more bonds are traded electronically now than by voice. So that's, I think, a positive trend. It is still on the smaller ticket. So if you want to trade 200 million, you do it by voice. If you trade 1, 2, or 5 million clips, then it's easier to do that by technology. But we try to data mine this with algorithms, or you can call it AI if you want, to see certain market trends. So do we see in the secondary market Asia coming up, or do we see central banks coming up? So we're trying to do data mining on big data sets. That's one element where we as ESM have spent efforts in order to understand markets better.
Okay. I apologize. I've just been told that we're out of time. I'd like to conclude. We do have one last question. We won't be able to get to the subject, but a question, if we could put that up on the screen, please. Audience poll: is the leading geopolitical concern for next year going to be COVID and its aftermath, fallout from Brexit, regime change in the United States, or the financial and political instability in Turkey, or an as yet completely unforeseen shock? And I'd like to thank my participants, Tom, Nils, Wilfred, and Kaelan, for a very interesting panel and for putting the time in and providing us with a lot of quality information. Thank you very much, gentlemen.
Thanks, Mark.
Thank you very much, Michael and panelists, for a very engaging and insightful discussion, especially in such uncertain times and in the absence of a crystal ball. I hope we've all at least gained a little more clarity about what we are likely to expect following this pandemic. I'm now delighted to introduce our final session for today, our keynote speaker, Mr. Tom Orlick, who has very kindly agreed to join us all the way from Washington, DC, where I work out it's about 6 o'clock in the morning his time.